Hello, everyone. Here we are at the end of the summer, or close to it, anyhow. I hope you've all had a great few months, and I haven't chatted with you for a little while here, at least not all of you. Um, I just want to give an update. As you are likely aware, the Bank of Canada held its rate last week. They did leave the door open for possibly another increase this year, but I kind of think that they're trying to be very, very cautious on the wording because the markets will react to every interpretation um, that is sort of leaked out in that report. So um, we're flat now, and the employment rates or employment information came out on Friday, and it showed an increase, which was not expected. That increase has been attributed to immigration, lots of newcomers to the country, and everyone's vying for work, and obviously services are required. So there's been a bit of a bump there, not huge, but a bump nonetheless. And these little cracks. I mean, I think we had just over 100,000 people in the last month come into the country. So there's pressure that's created with that, and I would argue that the inflationary rate, which is what the government has been, or the Bank of Canada has been watching very, very closely, is still probably a little higher than where they would like it, but it's largely due to interest costs and housing costs in general. So um, now the shift is they're looking closely at employment numbers, which they're still trying to get that up to the pre-pandemic level of 5.7 to 6%. And when we have increases like this, it's not working for us. So you could argue those two factors are government-induced decisions. Um, we have to live with that, but I do think that we may be at the top of this cycle right now. um, I see a lot of listings, not a lot, but I've seen a bit of a spike in listings over the last month, and they're not on the market long. Sold signs are on there really, really quick. We've got a handful of clients that are trying to buy that can't. They're losing out, and then they lose confidence, and so I think the sidelines are quite full right now with people that would love to be in but are hesitant and aren't. And you see that, I'm sure, day to day with your business. So where rates are sitting now, the bond yields, as I've mentioned numerous times, sort of predicate where the fixed rates are. We're still bullish on 3-year terms, and right now they're advertised around 6.5 or 6.05%. 5 years probably around 6, just under. 2 years are probably closer to 6.3, 6.4, somewhere there, depending on lender again. And again, I won't get into the whole insured, uninsured, insurable breakdown. But bond yields have been floating up. They've been floating down since about March. And so we try to stay on top of that. We've got a file right now that's going to complete in the next couple of weeks. And last week, we were able to get that contracted 3-year rate of 6.03 down to 5.75. So, a savings for sure. And again, not all lenders are doing this flex, but we've got a couple that will. So we're leaning that way as much as we can. The 3 years, I said, is the rate that we're kind of, or the product that we're bullish on. I think that may move into the 2-year, depending on the gap between the 3 and the 2 on the rate, as well as variable may be an option as we get into the new year, especially if things ease and if the Bank of Canada does hold rates again the next meeting. Variable may prove to be a viable option. And again, the theory there would be, when the rates start to come down, maybe you do lock into another fixed rate in a couple of years when the fixed rates are below 5% or maybe in that 4% range. So it's all wishful thinking at this point in time, and all we can do is just watch what happens with the markets. So on that note, I'll leave you to have a great week. You know where to find us if you need to. Any questions, any conversations, we love to have a chat. So have a great one. Bye for now.